Welcome everybody to Wall Street Reporter's next Superstock live stream, March 17th. We are back with the Reliq Health Tech. Again, for those new to our program, our goal is to bring you those stocks which have that 10x to 100x upside potential. So companies, going after massive market opportunities at a key inflection point, and with multiple catalysts in place. And Reliq definitely has all three of those, and they have a great CEO. Speaking of which, Lisa, again, welcome back.
Thank you. Thanks for having us.
Absolutely. So, it's congratulations, by the way, on the Florida news this week.
Yeah, no, it's very nice for us to be able to get back into some of these states that were really shut down in terms of healthcare, particularly on the proactive healthcare side during the pandemic. So this is a real positive indicator for us of, the way that the U.S. market is moving. So we've been watching the vaccine rollout south of the border. We're Canadian, very closely, and this traction in Florida, where we're now planning to start next month with onboarding this client, is actually an acceleration over where I thought we would be in Florida. We thought that it would take until the second half of the year before Florida would really be able to reopen at all in terms of the kind of proactive healthcare that we support through our platform. So this is a real positive development, and we're starting to see similar developments in Texas. So and obviously other states, but those were two of the states where we had clients, but were really stalled out by the pandemic. So this is a very positive development for us, and it's very exciting. Obviously, anytime we sign a new client, and it's also indicative. I think we've spoken before about how skilled nursing. Well, then specifically in this market segment. So, skilled nursing facilities weren't really a market segment for us until about a year ago when Medicare and Medicaid introduced penalties for them around readmissions. So, it just speaks to how much traction we're starting to see in that completely new market segment. So there's just tremendous room for growth there.
Okay, so we're going to kind of dive right into this, but I think what's important about this news right now with the Florida contract, why I think it's an important milestone is this is really I think this is the fourth major contract you announced in like the last 6 weeks or so. So it really shows that the company really is not just at that inflection point, but it's already moving beyond it, and this is it's important because this is what you talked about when you first came on our platform, and you've been delivering, which is important that this is happening. So let's kind of get into this news. It's an interesting deal. You're going to be deploying, what is it, the IUGO, the telehealth technology at 25 of these skilled nursing facilities. This is what the contract is, yeah?
Yeah, that's right. So the skilled nursing facility market segment, they're very low margin businesses inherently. And with COVID, they've been hit really hard because you get, a few COVID outbreaks in a skilled nursing facility where a lot of people end up positive, and you end up with a real hit to the business. So, one thing that we do that's really enabling for the skilled nursing facility industry is we're creating new revenue streams for them. So their clinicians, a lot of the patients who come into skilled nursing don't actually have a family doctor. So they'll be using the emergency room as their family doctor. That's incredibly common with the Medicaid population in particular. So these physicians have an opportunity to work with these patients post-discharge. There's penalties if these patients are readmitted within 60 days of discharge from the skilled nursing facility. So our transitional care management module really helps to prevent those readmissions and save the financial penalties. But beyond that, the physicians at the skilled nursing facilities can provide annual wellness visits for patients for long periods post-discharge, and they can add them to remote patient monitoring or our behavioral health integration platforms. And that's entirely new revenue for the skilled nursing facilities. And it's doing something really socially important because it's catching these patients who don't have ongoing medical care, who are relying on the ER as their family doctor, which is not good medicine. That's not a good medicine.
Lisa, I think you should re-emphasize right now the value proposition that you're offering. Again, give us walk us through those numbers because it's an amazing value.
Yes, I mean, for a skilled nursing facility that's operating at a barely breaking even and, very narrow profit margins, because these are completely new revenue streams and they're very high profit, it completely changes the business model for skilled nursing. So they can generate hundreds of dollars per patient per month on an ongoing basis after the patient leaves the facility. So, that's really key, is that these patients used to have a kind of finite revenue cycle for the skilled nursing facilities, which was just the revenue they generated while the patient was admitted. But now they can generate revenue for years after the patient is discharged by providing wellness visits, remote patient monitoring, and behavioral health integration and other services afforded by our platform. And the real, social benefit is that these patients who previously had no one following their chronic diseases on a day-to-day basis now will have access to ongoing care, consistent care, and they'll get better health outcomes as a result. And the reason that the Centers for Medicare and Medicaid Services have allowed for skilled nursing facilities to start to offer this post-discharge care, and that's quite new, that's a little bit over a year old, is really because these patients that they're catching, aren't being caught anywhere else in the system. And so by having that follow-on care from the skilled nursing facility, you do keep these patients from using the ER as their family doctor. And one ER visit is $15,000. So, for less than $500 a year, we're keeping these patients from incurring hundreds of thousands of dollars in healthcare costs, and we're giving them much better health outcomes and quality of life. But for the skilled nursing facilities, it's potentially millions of dollars in new revenue at a very high profit margin as compared to their core business, which is very low margins.
So there's really kind of two value propositions for your. Okay, so there's two things for these skilled nursing facilities. Basically, the value prop for them, essentially, this is like a no-brainer for them to kind of use your technology, because now they're going to get a recurring revenue stream. It's going to make a massive difference in their margins.
Yeah.
For the insurance companies, the remote patient monitoring for again for chronic cases. I think you went through some of the numbers. Basically, I think you said like 20% of these people will. 20% of the population that's in the chronic care will end up in have a major event that's going to cost could cost like six figures.
Yeah, it typically does cost six figures. So on average, 20% of any chronic disease patient population will end up admitted to hospital at least once during the course of a year, because these patients have complex chronic conditions. So, diabetes and hypertension are the two that people talk about the most, but, those are rarely found in isolation, and they lead to things like congestive heart failure and chronic kidney disease. So these patients tend to end up, when they are admitted to the hospital, in the intensive care unit, and that's hundreds of thousands of dollars per stay. So it's a very expensive way of caring for these patients, whereas a more proactive approach like ours, for less than $500 a year, you can reduce the cost of care for these patients by several orders of magnitude.
Okay, so I mean, I'm just so again, like if somebody does the math, essentially, if they're using your technology, it's it's let's call it $500 per patient per year.
Mm-hmm.
If you have let's say 5 patients on it, just use the number 5, it costs them $2,500. Whereas if they don't use it, odds are that one of those 5, because that's 20%, right? If I'm doing my math, one of those 5 is going to end up in the ER, and it's going to cost them $100,000. So $500 versus $100,000. I mean, I could see it doesn't take a rocket scientist to kind of.
Exactly. I mean, from the Centers for Medicare and Medicaid Services perspective, they can put thousands of patients on our platform and pay for that by just keeping one patient out of the ICU. So it's very, very cost effective, but it's also very good for patients, because every time they end up in the ICU, they come out a little worse than they went in. Not than they went in, than they were before they had the exacerbation that led to them going to the hospital. So if you can catch those exacerbations early, like we do with the platform, and intervene, you can prevent them ending up with permanent damage to the heart or the lungs or the kidneys, that really long-term, impact not just their quality of life, but also their lifespan.
Okay, so I mean, to me, it seems like this is really it's like a no-brainer for everybody to be using the you go to the Reliq Health, the platform. So because I mean, just the numbers is just so compelling for everybody. It's like a win-win-win. So my question is, you have 4 of these contracts. Why don't you have like 10 million people, 10 million patients on the platform right now? Like,
Yeah.
what is standing in the way between
Yeah.
where you are now and getting, let's call it, 2 million people on the platform?
Yeah. Yeah. So, I mean, bear in mind that really it's only over the last 2 years that Medicare and Medicaid have made this as financially compelling for clinicians as it currently is. And when we started out in late 2017 and 2018, it was January 1st, 2018 that Medicare introduced the first billing code for RPM, and it was at a much, much lower level of reimbursement than they are now. And over the last few years, they've validated for themselves that these kinds of initiatives do keep patients out of hospital and do substantially reduce healthcare costs. So they've now got a $100 billion budget devoted annually to this kind of proactive care, with the expectation that'll save them over $1 trillion a year going forward. And for us, onboarding is paced. Sorry.
Oh, so essentially, so Lisa, I want to say, so essentially, this opportunity that you have right now is created just recently because of this kind of bureaucracy, coding, all that stuff with the insurance.
Well, yeah, exactly. I mean, the payers really didn't know if there was. Oh, sorry.
Yeah. So no, the financial opportunity didn't exist really. I mean, the medical, the health, the care opportunity existed, but nobody was willing to pay for it. Now they're willing to pay for it. So this is a brand new. Okay.
Yeah, you're not going to, even though doctors do always want the best for their patients, you're not going to get them to start offering new services if there's no reimbursement around it. So, the fact that every year since 2018, Medicare has increased the number of billing codes, increased the size of the reimbursement, really shows that they've confirmed for themselves that there's a real ROI on the investment in proactive care. It's like in healthcare, trying to prevent forest fires versus dealing with raging wildfires in the emergency room or the ICU. And so it's very worthwhile work, but it took Medicare and Medicaid a while to get the data that showed them that, yes, this does actually work and it will reduce healthcare costs. So there's less than 5% of the patient population who qualify for services like ours are currently enrolled in any kind of program. And so it's still a very early stage market, but we've gotten from the point we started in 2017, 2018, where we were real missionaries, to the point where now, this is something that everybody in healthcare wants to adopt. And really, they do need to get through the pandemic. And, with the vaccine rollout, that's why we're expecting such significant growth for our business in the second half of the year. But this is the way that healthcare is going. This is, there's been a fundamental change to healthcare, moving away from the fee-for-service, or the more you see a patient, the more money you make, to, and the less the patient goes into the hospital, the fewer complications the patient has, the more money the physician makes. So, there's a huge appetite, and I think there's a lot more awareness of these billing codes now. So we are getting a lot of inbound sales. A lot of clients come to us, and I think we've talked about this before, but we have hundreds of thousands of patients in our pipeline. So for us, it's really just a question of working with the clients to onboard those patients. That's been very challenging during the pandemic because they're dealing with outbreaks at their facilities, or the physician practice, the physician's been seconded to hospitals to deal with COVID cases. But now that the vaccine rollout has really started to pick up in the States, and everybody's shifting focus back to how do we address this proactive form of care, and how do we, going forward, provide the best possible patient care and make money. And that's really, the answer to that is really a YouGoCare, our platform. So we're that several 100,000 patients that we have in our platform, we'll be working through those over the next year or two with clients. In healthcare, everybody likes to stage their rollout. So you do one facility, then you do 3, then you do 10, and so it's a little bit of getting that snowball going. But once it's started, it really picks up speed and size very quickly. So,
and that's what the market likes. The market likes to see that kind of that traction starts to happen. Then all of a sudden it's no longer a story. Then all of a sudden people can actually model the revenues, the earnings, and then okay. So something okay. So very interesting. You mentioned a couple things. One is, so you have a pipeline right now. You're saying you have a pipeline of several 100,000 patients that are going to be coming onto the system.
So that pipeline is, we've signed contracts with clients, and the patients these are the eligible patients. So the clients may have many, many more patients than that, but these are the patients that qualify under Medicare and Medicaid for our services. So we have several 100,000 patients that are covered under our contracts that will be onboarding over the next, 12 to 24 months.
Okay, so we're going to jump into some audience questions. Actually, so Ethan, we're going to go through. I think one of the questions is going to be that kind of the process of onboarding. But there's a couple of things I want to kind of address. Is that so you're really at the right place at the right time, and because with the billing codes, with kind of this shift that you're talking about in the healthcare world, where they're kind of moving to this subscription model, the SaaS model, where it's that recurring revenues, which it helps, and again, it helps everybody. So, the doctor will see the patients regularly. They keep them out of those, those one-time, emergency room events. So it's and Reliq kind of fits perfectly into where the healthcare world is going right now.
Yeah, I mean, we're in the right place at the right time, but there were a lot of years of work that went into positioning ourselves.
Well, the pioneers get the arrows in the back. You know how that works.
Yeah. No. I mean, I'm just saying one of our greatest competitive advantages is that we've done the work. We have years of clinical data now showing that our platform works. So any new entrant into this market is going to be 2 to 3 years behind us, because you do have to generate that clinical data to prove efficacy before you can get any healthcare clients to take a chance on you. So we did that serious heavy lifting and working with very small clients who maybe weren't as sophisticated as some of the larger networks. So we've done that work, and we've now gotten to a point where we're attracting these much, much larger clients, and they're coming to us because we've built a reputation in the space. But that's not an easy thing to do. So we've done that work, and I think investors getting in now are really benefiting from 5 years of, on the ground heavy lifting that we've done to put us in a position where now it's really just a matter of executing. We've done the missionary work. We've worked with the regulators, figured out what the landscape is and how we fit into the ecosystem, and especially around billing. So we're really uniquely positioned in this market to be the first mover and to really establish ourselves as a standard of care for proactive virtual care.
So I think so it's another, I think, important point that I think investors need to understand. Kind of the value proposition, for RHT is, you have this moat that you've established. I mean, the healthcare industry, they're not just going to go to this telemedicine with anybody. They want somebody that's established, that's already been around. It's a very conservative industry. So I think that actually creates massive value, like for the business.
Yeah, well, and I think if you look at the announcement that Amazon made today, so they're
I was going to ask about Amazon.
They're starting to offer telemedicine. It's basically teledoc. They're doing their own teledoc, and they're doing it for their own employees, but they're starting to make their services available to other employers. And they haven't had anyone sign on yet, but it's very early days. But what's interesting about what they're doing, I think it definitely shows that the industry has changed and there's a real commitment to virtual care. But what it also shows is, where you see the big companies playing is where they're comfortable. So, they like to work with employer-sponsored health plans, particularly if it's self-insuring their own employees, because there's very few regulatory barriers and the prices are higher. And where we see big companies like that always looking to partner or potentially acquire is when they get into the more complex ecosystems like the Medicare and Medicaid ecosystem, which is what we own right now, really. And that's a huge market.
You have this moat, basically, and the only way they can get into it is if they, in theory, would buy Reliq.
Well, it's not even so much a moat as it is, all of these big companies that have done something in healthcare, Google and Apple, who've developed, hardware or apps, and Amazon in this case, they really play to their own strengths. So either the technology side of it, or Amazon's really good at the logistics side of this. So they'll be great at setting up virtual visits and connecting doctors and patients. What they don't know anything about and have very clearly said in the past they don't want to get involved in on their own, so don't want to build up the infrastructure and the in-house expertise, is around these heavily regulated markets, like the Medicare and Medicaid market, which is, close to 40 million patients right now. So it's $100 billion market. It's a huge, high value market, but it's outside of the realm of expertise of companies like Teladoc and Amazon. And so, we've had conversations with very large multinationals who've, come to us and asked for, kind of advice on the healthcare ecosystem. And what they've all said to us is these innovative solutions that are very specialized in terms of their ability to work within these highly regulated spaces. No company, no big company is ever going to invest the time to build that. They're always going to partner or acquire. And so I think it shows that there's significant commitment financially on the part of companies like Amazon to getting into healthcare, but it still, very clearly shows that what they can do on their own is very limited. It's very much sort of the easy stuff, the just virtual visits, which is really a commodity business. I will say that this is not good news for Teladoc. Amazon is coming in and are going to compete head to head with Teladoc, but there's a lot of other telemedicine companies, and we certainly have seen over the last few months even a lot of mid-market telemedicine companies coming to us and saying, what we offer post-pandemic isn't even going to be funded by Medicare and Medicaid, or it's going to be funded at a much lower level than in-person visits. So, we need to do something different. And so there's a lot of opportunities for partnerships for a company like ours that brings something really unique to the market and that has demonstrated that we know how to work in this highly regulated space. And we have, credibility and an established brand and reputation in the space. So I think, it shows that there's a lot of dollars coming into healthcare from big companies. But I think it also, really shows that they like to stick to their own expertise when they build their own solutions. And then they like to partner like Teladoc did with Livongo when they get into more specialized approaches to healthcare.
Okay. I think, Lisa, I'm trying to read between the lines here. You're basically, I think you're saying is that, that Reliq would be an attractive acquisition for somebody like an Amazon. I mean, or something.
Yeah. Yeah, I mean, it's no secret that a lot of the big technology companies, not just a Google or Apple type technology, but big companies that work in data-driven spaces are looking for opportunities to flesh out their healthcare verticals and using some, a novel approach. So a lot of them already do data aggregation or they do telemedicine. These are kind of commodities in the space. But, we've heard from all of them, the reason they work with smaller companies is because they need that innovation and, small companies are nimble. This is something that big companies can't do on their own. So what usually happens is smaller companies like ours, they get the bigger companies like to see you get to a certain kind of minimum patient threshold. But then there's definitely significant, interest from big companies in acquiring companies like ours when you've got a captive patient base and this innovative new technology.
Okay. So, this is I like the way you're dancing around. So basically, Reliq would be an attractive acquisition for a big player who could write a big check. Is the concept? Which,
yeah, definitely. And I mean, just the reason I bring up, this is sort of a longer term thing is.
Yeah. I mean, it's not tomorrow. It's not going to happen tomorrow. It might.
No, it's certainly not going to happen tomorrow. But I think the good news about that is we've set ourselves up as a self-sustaining business. We don't need to be acquired in order to scale and be successful. But we don't have to worry so much about being acquired too early and not getting the kind of valuation we think we justify, because these big companies like to buy companies. I mean, look at Livongo. They paid $18.5 billion for that company. That's, really kind of where you start to see acquisitions is when you get companies over the $1 billion valuation, because that's when the big companies with their own internal mechanisms and machinery are actually capable of valuing that company and acquiring it. So, I think the good news is there's a trend to consolidation in this industry. We don't need to be acquired in order to be very successful. But if we were to be acquired, I think the good news is it won't be until we've really achieved a very significant valuation. So we don't have to worry about kind of being bought out early and shareholders not getting the full value out of an acquisition. Pardon me.
Okay. So so basically in plain English, the company. Yep. You don't need to be acquired because I mean you're building out this business, you have this organic growth, etc. But it would be an attractive acquisition. I don't know at what price. If let's say somebody came to you, I mean, it might be a little bit early, right? Because probably I'm sure you want to kind of create more value. You want to have I don't know, let's call it 100,000 patients in the in the system, or a couple 100,000. At that point, I don't know, $10 a share. I don't know. I don't want to throw numbers out.
I mean, obviously we can't predict how the market will value, the company, but I think realistically we'll be $1 billion valuation within the next few years. I won't sort of pin that down any further, but I think as we move through
one way or the other,
that's I think what I would call a near-term goal, and I think that's the point at which we would start attracting attention from potential acquirers. And so we have no interest in being acquired by anyone until we've at least crossed the $1 billion valuation mark. And I think that fits with the trends in the healthcare industry for, when companies are acquired.
Okay. So I think the kind of the bottom line here is your goal is to get to that $1 billion valuation, which is through, the internal growth. And you kind of laid out, on your last slide, on the last time you were on, you had that slide, which kind of showed the roadmap to that $1 billion valuation. Can you kind of walk us through that just now? Just again, how would you get there? What's the path?
Yeah, I mean, I think it's interesting because the healthcare market has been a little bit volatile, so it's always difficult to predict exactly what multiples will be. But what we've definitely seen over the last few years is that multiples in healthcare are extremely high. So when Teladoc bought Livongo, Livongo was operating either at a loss or very close to, and they got a 77 times revenue multiple. So that's massive. They were doing 240 million in revenue, and they were acquired for 18.5 billion. And so the way that companies in the space are valued, I think our projections in that slide that's on our in our slide deck that's on our website and that I presented here are very conservative. So we're, saying we'll do 11 million in revenue this year, 32 million the following year, around 65 million the year after, and that, the year after at about 100 million in revenue, we'd be $1 billion valuation company. I think it's, much more likely that we will be at $1 billion valuation much sooner. Where healthcare, the capital markets really reward healthcare companies is when you are profitable and showing aggressive growth. We'll be profitable next quarter, so by the end of June, and we're going to be showing very impressive, very rapid, really explosive growth in the second half of this year and for many years to come, because this market is so primed for growth, with less than 5% of the eligible patients already using a solution. So we've got a huge amount of growth ahead of us, and that will be very rapid. So, in terms of when do I think we'll be valued over $1 billion, I think that's a near-term occurrence. That's a milestone we expect to hit quite early. But, we try to be very conservative in terms of the formal guidance that we provide to the market. And so in the slide deck, we've kind of got that out several years. But I think if you do your homework and you look at software as a service companies and look at the multiples they get when they're showing the kind of growth that we'll have and they're profitable, and they're very compelling multiples.
Yeah, especially again, the space you're in is it's a very space. It's kind of the value, and the valuations are just they keep increasing. They're growing. Yeah. So I guess it's the important thing is for investors to understand is that there is kind of your vision for creating that $1 billion valuation, that shareholder value, so that and there's a real path to get there. You're on that path, and again, we're seeing with just this week's announcement is again, the journey to of 1,000 miles begins with the first footsteps, right? So you already made a bunch of footsteps, and it's getting pretty close. How many? Okay, so let's just run through the numbers. Revenues per patient. How would that translate into this 65 million annual revenues that you expect? Like, for example, the Florida contract. What are those patients going to be generating in revenues for Reliq?
Yep. So they're 5,000 patients at $50 a month, and you're getting up there into pretty compelling revenues. What was I going to? the one thing I want to sort of say about the revenue model and all of that is, keep in mind too that we're looking to uplist onto the NASDAQ next year, and companies on the NASDAQ get much more compelling valuations than companies on the TSX Venture. But in terms of our revenue projections and how that translates to patients, and so by the end of this year we'll have roughly 25,000 patients. By the end of the following year we'll have easily 60,000. By the end of the year after that, easily 120,000. So if you look at the patient numbers that we have in the pipeline and then look at that compared to those projections, you can see there's a lot of room to accelerate growth relative to what we've suggested in terms of guidance.
So basically, it's $500. I'm going to call it $500 per patient per. It's really 600 roughly, but let's say 500.
Yeah.
Okay. $500 per patient per year. If you have 100,000 patients, that's $50 million. Did I do the math correct? Yeah.
Sorry, what was your math?
100,000 patients.
Yes.
At $500 a year is $50 million. $50 million.
Yeah.
Yeah. So, and 100,000 patients is like, it's nothing. I mean, we have 300 million people in this country.
Well, and I mean, that's at that's at that price, but we, are trending towards a higher price. So over the last few months, most of the patients we've added are at $100 US per patient per month because they're using our care management services. So, obviously the more of our modules, the more of our services that patients are using, the higher the revenue per patient, and therefore the fewer patients we need to have in order to hit our milestones, revenue milestones.
Okay, so that's another interesting point. So you have kind of tiered pricing while you have other, so it could be, it's not just $50 a month, it could be $100 a month, whatever.
Yeah, exactly. Anyone who's using our care management services, it's closer to $100 per patient per month.
Okay, so again, 100,000 is not, I mean, you're getting, I mean, you have, with this deal, you can have just the Florida deal, you could have 5,000, 5,000 here, 5,000 here. All of a sudden, you're at 100,000. So,
yeah,
when do you expect to hit that 100,000 milestone?
Yeah, well, I mean, I think the guidance we provided the market suggests that it would be not 2022 but 2023. What I've always said about our guidance is I think there's a lot of potential upside there. So I think what will happen is over the rest of this year, you'll see really significant growth in the second half of this year. And at that point, we'll be able to revisit guidance based on data so that investors have a lot of confidence in the numbers that we're projecting. And, at this point, I think we want to be very conservative in terms of our guidance because we are early stage and, you get into crazy numbers, people don't necessarily, believe or understand that space. But we are very, very well positioned to not just hit our numbers over the coming years, but to really blow them out of the water. And just based on the contracts we have now, I mean, look at the contract we announced in California, where we have, they have 500 clinics and 5,000 physicians, and it's just it's hundreds of thousands of patients. So it doesn't take a lot of these accounts to get into really very, very high patient numbers. And so I think we're very well positioned to not just, meet our forecasted milestones in the near term, but to really significantly exceed them as we grow and move into 2022 and beyond.
Okay. Yeah, it seems like, okay. So I'm kind of, again, I'm reading between the lines here. You're being conservative, like the 100,000 it could happen much quicker. I mean, and I'm looking at the kind of the pace. It's an accelerating pace of new contracts, which is, I think the key word is accelerating. And I mean, I think if the market sees you sign up, I don't know, let's say 5 more of these deals by, I don't know, let's say May. I'm just saying May. So that would, potentially that could put you on a path to getting that 100,000 within 12 months.
Yeah, that's exactly right. And, we issued guidance at the beginning of January when, the vaccine rollout path was still a little unclear. And I'm certainly starting to feel a lot more optimistic about that vaccine rollout. And we're certainly getting the right signals from clients that they want to get moving and start finalizing the implementation plan. So they're really ready to move once their staff and patients have been vaccinated. So, I think it'll be a very good year, the second half of this year in particular, but we are already seeing growth. But I think 2022 is just going to be really explosive as we ramp up with each of the clients we already have, and not to mention we are adding new clients every month.
Okay, so and again, so you're going to be profitable in the next quarter, basically.
Yeah.
Okay, so so things are really on that. Okay, let me jump into a few questions. We got a few minutes.
I know someone asked about the onboarding process. Onboarding
is let's jump to that question here. There we go, from Ethan.
Yeah, so onboarding is very simple. We can do it all virtually, so we don't have to actually be there. And basically, it's a doctor writes a prescription for the patient to be onboarded onto our platform. So to start to receive remote patient monitoring or chronic care management or one of the other services. If they need devices, if they don't already have a glucose meter, a blood pressure cuff, or a scale, or whatever they need, the doctor can write a prescription to a durable medical equipment provider, and they'll ship the devices. So, we've onboarded patients with brand new clients in a week. And so we can do that quite quickly. What usually is the limiting reagent, and speaking from my chemical engineering days, in the equation is that healthcare, in general, healthcare organizations like to stage rollouts. So, they may have 100,000 patients, but they might want to start with one facility, and then, the next month they might add 3. So we're really providing guidance based on the most conservative projections of our clients, our current clients, as of January when we issued the guidance. But we've certainly found that as we start to onboard patients and clients understand how simple the process is, and how significant the revenue upside is for them, and that they start to accelerate over their initial implementation plans. So.
Okay. Shafin is asking, okay, a great question. What's going to be the biggest challenge you're going to face in the next 6 to 12 months?
Yeah, I mean, I think, when you talk about volatility, as this individual did, the volatility is in the capital market side. It's not so much in the healthcare space. So, the healthcare space has pretty consistent behavior and has for decades and decades. So, the pandemic threw a little bit of a monkey wrench in the works, but, without question, the healthcare industry goes where the money is. And so, because Medicare and Medicaid have really increased the funding around these programs and have validated that, they need to continue to do that because it's saving them so much money on the hospitalizations. And, the volatility doesn't really exist in the healthcare space other than things like surprise global pandemics. But hopefully
maybe that's what he was referring to as volatility. There's things like that or whatever. You never know.
Yeah, and I think in terms of the volatility in the capital markets, the bottom line is we're building a business that has very strong fundamentals. So this isn't a business built on hype, and we'll be profitable next quarter. We'll be throwing off a lot of free cash from that point on. And we've demonstrated that we have a lot of traction in this market and that's growing every day. And so I think, capital markets volatility tends to affect companies that are more kind of at a conceptual stage, and then companies that are consistently delivering real revenues. So, we don't worry too much about the capital market side. We focus just on building an actual viable business and that has really strong fundamentals. So I think over the long term, those are the businesses that succeed.
Yeah, I mean, well, one of the kind of the realities of our market is that, because RHT is, it's in the micro cap space.
Yeah.
Right now, all the micro caps, all the kind of the Tesla effect is really crushing across the board.
Yeah.
But I think that could be a very interesting opportunity for investors. Again, we're not giving buy sell recommendations or anything, but
no.
The valuation is becoming compelling because, again, the fundamentals of the company are accelerating, and you got this real path to get into.
And I think you have to look at the fundamentals of any business you invest in, and the advantage of a business that's success is predicated on organic growth is you're creating real value. If you are buying a company just because it's doing a lot of acquisitions, you never know how successfully those acquisitions will be integrated and whether or not there's so. Not that there's anything wrong with acquiring companies, and if the acquirer is really committed to integrating that new acquisition, like Teladoc with Livongo, they may very well be ultimately successful with that integration, but there's a long period of disruption associated with bringing in a new company and integrating it. And sometimes the synergies aren't as real in the end as they seem to be when the acquisition first took place. So I think the benefit of buying into a company that's projections are based on organic growth is you're really creating something of value, and there's not that inherent risk of will the acquisition be easily integrated and are there real synergies there or not.
Okay. So yeah, I guess the difference is, so with companies with the acquisition model, investors love to hear about acquisitions. They're that flow. In your case, they just got to watch the contracts because it's the same. It's the organic growth is they have to keep it on. Okay, Lisa, I'm going to wrap up two last questions here.
Okay.
One, near-term news flow. What else can we expect next 30 days? Anything in the pipeline?
Yeah, well, I can't tell you that because that would be selective disclosure. But I will say that we do continue to sign
people watching right now.
Yeah, we do continue to sign new contracts all the time, and we are very committed to being transparent with the market as we sign new clients. So there'll be lots of updates. I mean, we expect to be very frequently communicating positive news to the market, and not just in the next 30 days, but for quite a few years to come. There's a lot of growth going on within the company and a lot of new customer traction.
Okay. Last question. We always ask this, right now, where we are March 17th, in your opinion, top 3 reasons for investors to want to, own the stock today.
Yeah, I mean, I think, from the market perspective, there's a lot of market pull here that didn't exist a few years ago. So with Medicare and Medicaid significantly increasing reimbursement and adding to the number of billing codes, there's a lot of pull for our solution in the market right now. So that's one. Number 2 is it's a massive market. We're looking at over 37 million Medicare and Medicaid patients who have 2 or more chronic diseases. So, there's a pretty clear path to generating tens of billions of dollars in revenue in this space. And, I think the third reason is we are the first mover in this space. We've established ourselves as the standard of care, and we're just in the process of moving through. We've got there's 5% of the market, the patient market, who've onboarded or enrolled in any kind of a program even vaguely related to what we do. That leaves 95% of the market still to be enrolled and onboarded onto a platform, and we're really in the best possible position in the community care space to become the market leader there.
Okay. Fantastic. Lisa, thank you. On that note, again, I want to thank you and look forward to hearing more good news from RHT in the coming weeks, more contracts.
Yes. Thanks, Jack. Thanks very much. And thank you, everyone. And if anyone has questions that weren't answered, just email our IR team and they'll answer them for you.
Fantastic. Thank you again, Lisa.
Thanks. Take care.